August 3rd, 2014, 7 p.m., Lisbon, Portugal. Ricardo Salgado sat in his Avenida da Liberdade penthouse. 48 hours earlier, he controlled Portugal's second largest bank, managed $80 billion in assets. His family, the Salgados and Espírito Santos, had run Portuguese banking for 145 years, 7 generations, survived 2 world wars, outlasted Salazar's dictatorship, weathered the 1974 revolution. Now, arrested, bank seized, family empire destroyed. 4.4 billion, that's billion with B, in losses, in 2 weeks. One of Europe's oldest banking dynasties erased in 14 days. 20,000 Portuguese families lost their savings. Retirees who'd trusted the family name for decades, gone. Many lost everything, set aside for retirement. The Espírito Santo name, once synonymous with safety, with tradition, with Portuguese pride, became a symbol of betrayal. How does a 145-year-old bank, older than the Portuguese Republic itself, collapse in 14 days? What warning signs did regulators miss? And who really paid the price? This is Banco Espírito Santo. This is what happens when family legacy, political connections, and aggressive expansion collide with European banking rules nobody wanted to enforce. But this isn't just a Portuguese story. If you have international bonds in your portfolio, European mutual funds, pension investments in emerging or European markets. This pattern destroyed over $30 billion across European banks between 2008 and 2017. Most were ordinary people's retirement money. People who thought too big to fail applied everywhere. Let me show you the warning signs that appeared years before, and the reasons everyone ignored them. But first, understand the pattern. This isn't the first time, won't be the last. There's a pattern that repeats whenever family-controlled banks expand too fast during boom times. Stage 1, legacy shield. Family reputation creates trust. Regulators assume they've survived this long, they must know what they're doing. Stage 2, aggressive expansion. Easy credit fuels rapid growth. Family empire expands into insurance, real estate, foreign markets. Complex corporate structures hide problems. Stage 3, warning signs. Ignored, auditors notice issues. Analysts ask questions. Family connections and political influence silence concerns. Stage 4, credit crisis. Economy slows, hidden debt surface, complex structure collapses under pressure. Regulators finally investigate. Stage 5, rapid collapse. Confidence evaporates. Bank run begins. Government intervention too late. Ordinary savers pay the price. Italy's Banco Ambrosiano followed this in 1982. 1.3 billion lost. Vatican Bank implicated. Ordinary Italians' savings destroyed. Spain's Bankia followed this in 2012. $22 billion bailout. Retail investors who bought IPO shares lost 60%. Pensions wiped out. Ireland's Anglo-Irish Bank followed this in 2009. $30 billion in taxpayer money, equivalent to $6,500 per Irish citizen. Same pattern, different name, same devastation. In 2011, Banco Espírito Santo entered stage 3. Let me show you how. To understand the collapse, you need to understand what Banco Espírito Santo was and what made it different from American or British banks. 1869, José Maria do Espírito Santo e Silva founded Casa de Câmbios Espírito Santo e Silva in Lisbon, a currency exchange house, small, family-run, conservative. Over 145 years, this family business grew into Portugal's second-largest financial group, but it remained family-controlled, not publicly owned like Chase or Barclays. The Espírito Santo and Salgado families directly controlled the bank through a holding company structure. Think of it like this. Instead of shareholders voting on decisions, one extended family made all the calls. That's how Portuguese and Spanish banking traditionally worked. Family dynasties, generations of control. The structure looked like a pyramid. At the top, Espírito Santo Financial Group, ESFG, the family holding company. Middle layer, Espírito Santo International, ESI, for offshore investments. Bottom, Banco. Espírito Santo, BES, the actual bank where you deposited money. The family used this structure to move money between companies. Legal? Technically? Transparent? Absolutely not. Regulators couldn't easily track what the holding companies were doing. The actual bank, BES, where ordinary Portuguese kept savings, that was regulated. But the family holding companies above it, much less oversight. If you remember the 2008 financial crisis, you saw similar structures in America, like AIG's complex network of subsidiaries. Regulators couldn't see the full picture until too late. Same problem here. By 2000, the Espírito Santo empire had expanded beyond banking. Banking, Banco Espírito Santo. Insurance, Espírito Santo. Seguros, healthcare. Espírito Santo. Saúde, hospitals and clinics. Tourism, hotels and resorts. Foreign investments, Brazil, Angola, Venezuela. Operations, diversification or risk spreading, depends on execution. At the center, Ricardo Salgado, born 1944, grandson of the founder, educated in Switzerland, joined family business 1970s, became CEO of BES in 2000. Salgado was known as the banker of bankers. Former Portuguese Prime Minister José Sócrates called him untouchable. He had relationships with every major Portuguese politician, every business leader. When Portugal negotiated its 2011 EU bailout, Salgado was in the room. This matters because these connections would later delay regulatory action when problems emerged. But there was a fatal flaw in this structure. The bank, BS, where ordinary people deposited money, regulated by European banking rules after 2008, required to maintain capital reserves, subject to stress tests, audited regularly, the family holding companies above it, ESFG and ESI, barely regulated, could take on massive debt, could invest in risky ventures, could lend money to family businesses without proper oversight. The family used the bank's reputation, 145 years of trust, to borrow billions for the holding companies. Then they invested that money in increasingly risky projects, real estate in Angola, Venezuelan bonds, complex financial instruments nobody fully understood. When those investments failed, and they would, the losses appeared in the unregulated holding companies, not the bank, at first. This matters because if you had deposits in BES, you thought you were protected by European deposit insurance, $100,000 guaranteed by the Portuguese government, safe. But if you'd bought bonds from ESFG, the family holding company, you had no such protection. Many Portuguese retirees did exactly that, trusted the Espírito Santo name, bought what they thought were bank bonds, actually bought holding company debt. Same name, same family, different legal entity, massive difference in protection. Most never understood the distinction until it was too late. Stage 1, Legacy Shield, 2000-2008. The year 2000 marked a turning point. Ricardo Salgado became CEO of Banco Espírito Santo. He inherited a conservative Portuguese bank, $30 billion in assets, solid, boring, profitable. But Salgado looked around and saw opportunity. The euro had just launched. European integration meant Portuguese banks could expand across borders. Interest rates were low, credit was cheap. Every major European bank was growing aggressively. Salgado faced a choice: stay conservative, keep the family bank small, safe, profitable, or expand, chase the growth everyone else was capturing. He chose expansion. This was the moment. The first temptation. Stay with 145 years of conservative banking tradition, or join the European Growth Party. First move seemed prudent. 2001, BES expanded into Brazil. Large Portuguese-speaking market. Made sense. Brazilian economy was growing. Portuguese expatriates there needed banking services. 2003, BES opened private banking in Switzerland. Wealthy Portuguese wanted offshore services. Competitors offered them. Why not BS? 2005, BES entered Angola, former Portuguese colony. Oil boom underway. Portuguese banks had historic relationships there. Reasonable moves. But notice the pattern. Each expansion took BES into markets with less regulation, less transparency, more risk. Brazil in early 2000s, emerging market with currency volatility. Angola, autocratic government, high corruption, oil revenue dependent. Switzerland, offshore banking, less disclosure. If you remember the early 2000s banking boom, every bank was doing this. HSBC expanded aggressively. Royal Bank of Scotland bought competitors globally. It seemed normal, safe even. Everyone was growing. Who was BS to stay small? The problem? BS wasn't like HSBC or Deutsche Bank. Those banks had thousands of shareholders, public accountability, independent boards, professional management. BES had one family making decisions. Salgado answered to relatives, not to independent directors, not to public shareholders asking hard questions. By 2007, the family empire had grown dramatically. BS Bank, $80 billion in assets, up from $30 billion in 2000. Insurance, major Portuguese insurer. Healthcare, 8 hospitals, 25 clinics. Real estate, commercial properties across Portugal. Foreign operations, Brazil, Angola, Venezuela, Switzerland. The Espírito Santo name was everywhere. Portuguese television shows sponsored by ES Insurance. Hospitals named Espírito Santo. The family had become Portugal's Rockefellers. Then 2008 happened. Stage 2. Aggressive expansion, 2008-2011. Lehman Brothers collapsed September 15th, 2008. You remember? Global financial system froze. Banks stopped lending, stock markets crashed. Governments scrambled to prevent complete meltdown. Most banks pulled back, cut lending, sold assets, raised capital to survive. Ricardo Salgado did the opposite. He saw crisis as opportunity. Competitors were weakened. Assets were cheap. Credit was available from the European Central Bank at near zero interest rates. Other Portuguese banks were contracting. BES could take market share. 2009, BES increased lending by 12% while competitors cut. Aggressive, but deposits were growing. Portuguese people trusted the Espírito Santo name. 2010, the family holding companies, ESFG and ESI, took on massive debt. $5 billion in new bonds sold to investors. Promised 6 tar 8% returns, higher than government bonds. Many Portuguese retirees bought them. Trusted name. Good interest rates. Seemed safe. Where did that $5 billion go? Venezuelan government bonds. 14% interest. Very risky. Venezuela's economy was already showing stress under Hugo Chavez. Angolan real estate. Oil boom projects. No independent valuation. Family connections. Approved deals. Brazilian infrastructure loans. High interest. Questionable borrowers. Portuguese real estate at peak prices. Just before the market crashed. This is where it started going wrong. The bank, BES, where your deposits were, that was still somewhat stable, regulated, audited, subject to European banking rules. But the holding companies? Taking enormous risks with borrowed money, investing in countries and assets that were about to crater. Let's do the math on the Venezuela investment. Normal sovereign bond interest, stable country, 3 to 4%. Venezuelan bonds, ESFG bought, 14% interest, extra yield, 10, 11 percentage points. That extra yield signals extra risk. Markets were screaming, Venezuela is unstable. Amount invested, $800 million, roughly $1.1 billion at the time. By 2013, Venezuela was in crisis. Currency controls implemented, inflation accelerating, bond payments delayed, default risk soaring. Market value of those bonds by 2014, $300 million loss, $500 million. One investment. $500 million gone. That's €500 million. For perspective, $500 million would fund full state pensions for 5,000 Portuguese retirees for 10 years. Wiped out by one bad bet. But Salgado and family didn't disclose this loss. Not immediately. They buried it in complex accounting, shifted it between holding companies, delayed reporting. Meanwhile, they kept selling bonds to Portuguese retirees. Keep raising money, keep the machine running. Why would anyone buy bonds from a company losing money? Because they didn't know it was losing money? The Espírito Santo name still meant safety. 145 years of history. Your grandparents banked there. Your parents banked there. Why wouldn't you trust them? That's the power of legacy. And the danger. By 2011, the situation was getting worse. Portugal itself needed an EU bailout. $78 billion. The country was drowning in debt. Greek debt crisis had spread. Portugal, Ireland, Spain, all struggling. Portuguese economy contracted. Unemployment rose. Real estate values collapsed. Loans went bad. Remember all that Portuguese real estate the ES holding companies bought at peak prices in 2007, 2008? Now worth 30-40% less, but still carried on books at old values. If you had investments in European mutual funds during this period, you watched your statements shrink. This is why. Banks like BES were holding assets marked at inflated values. When reality hit, losses cascaded. This is stage 2 of the pattern. Aggressive expansion. Hidden losses mounting, reality approaching. Someone was about to notice. Stage 3, warning signs. Ignored, 2011-2013. This is where we are in the pattern. Stage 3, this is where it becomes visible if anyone is looking. 2011, international auditing firm KPMG was reviewing the Espírito Santo Financial Group, the family holding company. Auditors found problems. Complex transactions between family companies that made no economic sense. Loans to related parties without proper documentation. Assets valued at prices that seemed inflated. Offshore structures in Panama and British Virgin Islands that obscured ownership. KPMG raised concerns internally. What happened? Ricardo Salgado called the lead auditor personally, explained these were normal family business arrangements, reminded them the Espírito Santo family had banking relationships for 145 years, suggested KPMG was inexperienced with Portuguese family business structures. Translation? Back off. KPMG issued what's called a qualified opinion. Audit speak for, we found problems, but the company won't fix them. Not a full red flag, but not clean either. In normal markets, a qualified audit opinion tanks a company's stock. Investors flee, bond buyers demand higher interest. For Espírito Santo, nothing happened. Portuguese financial press barely mentioned it. Why? Salgado's connections. He sat on multiple corporate boards, knew every major Portuguese journalist. The family advertised extensively in Portuguese media. ES Insurance sponsored major television shows. Nobody wanted to attack Portugal's most prominent banking family, especially during a national economic crisis. BES was still lending when other banks had frozen credit. The family was seen as patriotic, supporting Portugal through hard times. If you remember America's 2008 crisis, similar dynamics played out. Rating agencies afraid to downgrade major banks. Media hesitant to question too big to fail institutions. Regulators captured by industry influence. Same pattern here. Different country. Same result. Warnings ignored. 2012. Portuguese central bank, Banco de Portugal, began its own investigation. They found something disturbing. The bank, BZSIs, was lending money to the family holding companies, billions of euros. The holding companies then used that money to buy bonds for themselves or invest in projects they controlled. Let me explain how this worked. Step 1. Portuguese depositors put 100 million in BES bank accounts, safe, insured. Traditional banking. Step 2. BES Bank lent $100 million to ESFG, the family holding company, called it a corporate loan. Standard practice. Step 3. ESFG used that $100 million to buy bonds from ESI, another family company, also standard. Step 4. ESI used that $100 million to invest in Angolan real estate project, controlled by Espírito Santo family. See the circle? Depositors' money, bank, holding company, another holding company, family project. Each transaction legal, each step documented, but the system as a whole, designed to move depositors' money into family investments with minimal oversight. When the Angola project failed, and several did, who lost money? Not the family directly. They borrowed the money. Loan was on the holding company books. Losses there. But who's owed that loan? BES, the actual bank, where ordinary depositors kept savings. So losses in Angola eventually hit BES, which means they hit depositors. Complex structure. But ultimate effect. Your deposits funded risky investments you never agreed to make. Portuguese central bank calculated BES had $4.2 billion exposed to family holding companies by end of 2013. That's $4.2 billion in loans that might not be repaid if those companies failed. $4.2 billion, more than Portugal's annual education budget at the time. What did regulators do? They asked BES to reduce exposure. Risk management, they called it. No enforcement, no penalties, just a request. Why so gentle? Portugal was still an EU bailout program, economy fragile. BES was one of only 2 large Portuguese banks still stable, or appearing stable. Government feared collapsing BES would trigger wider panic. Political calculation. Better to hope the problem resolves itself than force a crisis. Hope is not a strategy. But it was the strategy. 2013. Portuguese financial analyst Maria Santos published research questioning ES holding company debt levels. Her report noted, ESFG debt had grown 400% since 2008, profitability declining even as debt increased. No clear disclosure of where borrowed money went, bond yields rising, market signaling doubt. Santos recommended investors avoid exposure until clarification. Careful language, not accusatory, just concerned. Response: Salgado's lawyers sent letter threatening defamation lawsuit. Her employer, a small Lisbon research firm, pressured her to retract. She didn't, but the report never got wide distribution. Portuguese financial media buried it. This is how it works. Attack the messenger, threaten legal action, use influence to suppress. Maria Santos was right. Her analysis, had anyone paid attention, predicted what was coming. By end of 2013, the warnings were everywhere. KPMG's qualified audit opinion, central bank concerns about related party lending, independent analyst warnings, rising bond yields signaling market doubt, Venezuelan investments deteriorating publicly, classic warning signs, same ones that appeared before every major banking collapse. If you watched your European fund holdings closely during this period and saw Espírito Santo in the portfolio, these were the red flags you could have caught. Most people didn't look. Trusted the name. Trusted 145 years. This was the last chance to get out, to pull deposits, to sell bonds, to demand answers. Instead, the machine kept running. Money kept flowing. Losses kept mounting. Stage 3 complete. Next comes the breaking point. Stage 4, credit crisis. January-July 2014. January 2014. The facade started cracking. Espírito Santo Financial Group, the family holding company, delayed publishing its annual financial results. Said it needed additional time for accounting review. Standard excuse. Not standard timing. Bond markets noticed immediately. ESFG bond yields, the interest rate investors demanded, jumped from 6% to 9% overnight. Translation, markets suddenly seeing much higher risk. Think about that. January 2014, ESFG bonds traded at 6%, suggesting moderate risk. By February, 9%, signaling serious doubt. What changed in 1 month? Nothing changed. Reality was catching up to perception. The problems were there in 2013, 2012, 2011. Markets had ignored them, trusted the name. Now the delayed financial report was triggering doubt. If you held European bond funds with exposure to Portuguese debt at this time, this is when you'd have seen first losses. Value dropping. No explanation in your statement. Just market conditions. Market conditions was code for, we're finally noticing the problems. March 2014. Portuguese authorities raided Espírito Santo offices, financial crime unit, looking for evidence of accounting fraud, money laundering, violations of banking rules. Now it was public, couldn't hide anymore. Portuguese media, previously silent, suddenly interested. Headlines: ES under investigation. Family empire questioned. Are deposits safe? That last question, are deposits safe? That's when retail panic starts. Remember, most Portuguese didn't understand the distinction between BES, the regulated bank, and ESFG, the unregulated holding company. Same name, same family. Media wasn't explaining the difference clearly. Average depositor heard, Espírito Santo under investigation. Thought, my money is at Banco Espírito Santo. Is it at risk? Technically, deposits up to $100,000 were guaranteed by European deposit insurance. Safe. But psychology doesn't work on technical distinctions when panic starts. April 2014. Ricardo Salgado held a press conference, tried reassurance. He said, Banco Espírito Santo remains strong. We have adequate capital. Deposits are completely safe. These investigations concern corporate structure issues, not the bank itself. Partially true. BS, the bank, still met European capital requirements on paper. But that $4.2 billion owed by family holding companies to the bank? If those companies failed, the bank would have to write off those loans. Then capital requirements wouldn't be met. Bank would be insolvent. Salgado knew this. Regulators knew this. Question was, would holding companies actually fail? May 2014. ESFG finally published delayed financial results. The numbers were devastating. $3.5 billion in debt. $1.2 billion in losses. Previous year alone. Negative equity. Liabilities. Exceeded assets. Multiple asset write-downs from Venezuelan, Angolan, and Portuguese investments. Translation: the holding company was insolvent, bankrupt, could not pay its debts, and the bank BS was owed $4.2 billion by this insolvent entity. The math became undeniable. June 2014. Portuguese central bank ordered Salgado removed as CEO. Forced resignation. First time in 145-year history, family lost control. Too late. The damage was done. Confidence shattered. Depositors, especially large corporate clients, started withdrawing. Not panic, quiet withdrawals. Moving money to German or French banks, safer jurisdictions. By end of June, BES had lost $5 billion in deposits. 10% of total deposits in 3 weeks. This is what bank collapse looks like in modern era. No lines outside branches, no visible panic, just electronic transfers. Digital bank run, silent, deadly. July 10th, 2014, ESFG defaulted on bond payment. $150 million owed to bondholders. Didn't pay. Many of those bondholders? Portuguese retirees who'd bought ESFG bonds thinking they were investing in the stable bank. Maria Rodrigues, 68-year-old retired teacher from Coimbra. She'd invested $50,000, her entire retirement savings, in ESFG bonds. Broker told her, safe as bank deposits, but better interest. She trusted Espírito Santo name. Her father had banked there. Her grandfather. July 10th, those bonds became worthless. $50,000 gone. Her retirement gone. She told reporters, they said it was safe. How can 150 years disappear like this? How indeed. July ended with BES stock down 60% from January. Bond yields at 15%. Distressed territory. Deposit outflows accelerating. The bank had days, maybe weeks. Salgado, now removed from control, told associates, this is temporary. The family will survive. We always have. He was wrong. August 1st, 2014. 6 a.m., Banco de Portugal, the central bank, received emergency report. BES lost $10 billion in deposits in past 72 hours. Corporate clients, wealthy individuals, foreign banks, all pulling money. At this rate, BES would be out of cash by Monday morning. That weekend, European banking officials held emergency conference calls. Portuguese finance minister flew to Frankfurt. ECB, European Central Bank, needed to approve any rescue plan. Options: full bailout, government injects capital, takes control. Cost, $5-7 billion minimum. Controlled collapse, let BES fail completely. Risk, panic spreading to other Portuguese banks. Resolution, split bank. Good assets to new entity. Bad debts left in old shell. They chose option 3. August 3rd, 2014. 7 p.m. Portuguese central bank announced intervention. Banco Espírito Santo split into 2 entities. Novo Banco, new bank, created overnight, received all deposits, healthy loans, functioning branches, $4.9 billion government capital injection. This was the good bank. Ordinary depositors' money transferred here. Safe. Banco Espírito Santo, old entity, left with bad loans, holding company debt, toxic assets, set for liquidation. Shareholders and bondholders would lose everything. This was the bad bank. The burial ground. Technically brilliant. Protected depositors, prevented panic spreading, followed EU banking resolution rules. But thousands still lost everything. Who paid? Shareholders. BES stock went to zero. $2 billion market value vaporized. Many were Portuguese families who'd held stock for generations. Inheritance, gone. ESFG bondholders. $3.5 billion in bonds, worthless. Remember Maria Rodriguez, the retired teacher? She lost $50,000. She wasn't alone. 20,000 Portuguese families held these bonds. Average loss, $35,000 per family. Senior BES bondholders. $2 billion in bonds transferred to bad bank. Eventual recovery, 20-30 cents on the dollar. Employees, 8,000 BES employees. Within 6 months, Novo Banco laid off 2,000 middle-aged bank employees. Skills specific to BES systems. Hard to retrain, hard to hire. Let's do the math on total damage. Direct losses, ESFG bonds, $3.5 billion, zero, total loss. BS stock, $2 billion, 0 hours, total loss. BS senior bonds, $2 billion, or 0.6 billion recovery. 1.4, 1.6B loss. Nice government injection, $4.9 billion taxpayer cost. Total, 11.8 to 12 billion direct losses. Indirect impacts, Portuguese GDP, 2014, $174 billion. BES losses, as percent of GDP, 6.8%. For comparison, U.S. 2008 bank losses were 4 to 5% of GDP perspective. $12 billion would fund Portugal's public universities for 8 years, or provide $1,200 to every Portuguese citizen, or double the country's healthcare budget for 1 year, one family's banking empire. $12 billion destroyed, 14 days from investigation to collapse. Same time frame as Lehman Brothers in 2008, same speed, different continent, same devastation. Within 48 hours of announcement, Portuguese police arrested 4 Espírito Santo family members. Charges, fraud, money laundering, forgery of documents. Ricardo Salgado arrested at his Lisbon apartment, taken into custody. First time in Portuguese history a major banking dynasty head was arrested. Investigators found Swiss accounts totaling $400 million in family names. Property in Panama, Cayman Islands, British Virgin Islands. Art collection valued at $80 million purchased with company funds. Falsified documents showing healthy assets to auditors while hiding losses. The scale of deception was enormous. Not mistakes, not aggressive accounting, fraud, systematic, years long, calculated. August 10th, 2014, 1 week after collapse. Novo Banco opened for business. Lines formed outside branches, not to withdraw, but to confirm deposits were safe. Most Portuguese with deposits under $100,000 protected, money transferred, accounts functional. European deposit insurance worked. But the bondholders, those who trusted the Espírito Santo name, bought what they thought were safe investments, gone. No protection, no rescue. The Espírito Santo name, 145 years, erased in 2 weeks. So what happened next? Who actually paid? Who escaped? Ricardo Salgado, arrested August 2014, charged with 65 counts of fraud, money laundering, tax evasion, document forgery. Trial began 2020, 6 years later. As of January 2026, the trial continues. He's 81 years old, diagnosed with Alzheimer's disease 2023. Lawyers argue he's unfit to stand trial. Prosecutors counter, disease convenient, timing suspicious. He's never served prison time, house arrest, monitored, but free, living in his Lisbon apartment. The same apartment where he sat on August 3rd, 2014, watching his empire disintegrate. 3 other Espírito Santo family members faced charges. José Maria Espírito Santo, sentenced to 6 years, 2021, served 18 months, released on appeal. Joaquim Espírito Santo, still awaiting trial, case pending 12 years. Manuel Fernando, Espírito Santo, charges dropped 2019, insufficient evidence. Pattern familiar? People who caused the crisis either not convicted or serving minimal time. Now let's talk about who actually paid. Portuguese taxpayers, $4.9 billion government injection into Novo Banco. That's $470 per Portuguese citizen. Every man, woman, child. Money that could have funded schools, hospitals, pensions, gone. Used to clean up one family's mess. But it gets worse. 2017, Portuguese government sold Novo Banco to American private equity fund Lone Star. Price, $1 billion, $750 million cash, $250 million deferred. Math, government put in $4.9 billion, recovered $1 billion net loss, $3.9 billion worse. Sale agreement included contingent capital mechanism. Fancy term meaning if Novo Banco found more bad loans, Portuguese government would cover losses up to $3.9 billion more. Lone Star found more bad loans, $2.9 billion more in losses 2018-2020. Portuguese government paid $2.9 billion. Total taxpayer cost, $4.9 billion initial, plus $2.9 billion additional. Steward, $7.8 billion. $750 per Portuguese citizen. Almost $3,000 for a family of four. If this sounds familiar, because you remember 2008 American bailouts, patterns identical. People who cause crisis, minimal consequences. People who pay, ordinary taxpayers who did nothing wrong. Beneficiaries, foreign investors buying distressed assets cheap, same playbook, different country, same result. Recovery for bondholders, minimal. ESFG bondholders, the 20,000 families who bought family holding company bonds, formed association, hired lawyers, sued for recovery. 10 years later, recovered, 5/8 cents on the euro. If you lost $50,000, you got back $2,500, $4,000. Maybe, after legal fees. Maria Rodriguez, the retired teacher, died 2019. Never recovered her savings. Lived final 5 years on minimal state pension, $450 per month. Poverty line in Portugal. She told her daughter before dying, "I trusted them. Everyone did. How could they?" Where is the Espírito Santo family now? Ricardo Salgado, house arrest, still wealthy despite asset seizures. Estimated $100 million in family trusts untouched. Other family members, some in Portugal under investigation, some moved abroad, London, Switzerland, Brazil, living quietly, wealthy. The Espírito Santo name removed from all businesses, bank renamed, insurance company sold, hospitals rebranded, on item 45 years erased. But the family's personal wealth, hidden in offshore trusts, foreign properties, complex structures, mostly protected. System failed, again. So what does Banco Espírito Santo teach? Not just about Portuguese banking, about trust, about systems that should protect ordinary people's savings, about warning signs that always appear and always get ignored. Lesson 1, legacy is not safety. 1 in 45 years, 7 generations, survived 2 world wars, dictatorship, revolution. Portuguese assumed they've lasted this long, they must be safe. Wrong. Long history doesn't guarantee safety. Sometimes it creates dangerous complacency. Regulators assume they know what they're doing. Investors assume too established to fail. Media assumes too important to question. Same pattern appeared with Barings Bank, 1762-1995. 233 years, collapsed from rogue trader. Lehman Brothers, 1850-2008. 158 years destroyed by mortgage bets. BS, 1869-2014. 145 years, killed by family hubris. If you remember the savings and loan crisis in 1980s, America, same lesson. Established institutions with decades of history collapsed because management got reckless. History doesn't protect against bad decisions. What to watch? Delayed financial reports like ESFG January 2014. Qualified audit opinions like KPMG 2011. Rising bond yields without clear economic explanation. Rapid expansion into unrelated businesses. Legacy creates trust. Trust without verification creates danger. Lesson 2, complex structures hide problems. The holding company pyramid, ESFG over ESI over BES, wasn't accidental, designed to obscure, move money between entities, hide losses in unregulated layers. When you see complex corporate structures, especially in financial companies, ask, why? Legitimate reasons exist. Tax efficiency, regulatory compliance, international operations. But often, complexity hides problems. Same pattern in Enron. Hundreds of special purpose entities hiding debt. AIG. 2008. Complex derivative structures regulators couldn't track. IJC BES. Family holding companies moving money through offshore entities. If you have international bond funds or emerging market investments in your portfolio, check the fund's holdings disclosure. Look for family-controlled banks or holding companies. Avoid companies with excessive complexity. Prefer transparent, publicly traded institutions. Complexity is often camouflage for fraud. Lesson 3. Political connections. Delay accountability. Remember auditors raising concerns in 2011? Nothing happened. Central bank noticed problems 2012. Gentle requests, no enforcement. Analyst warned 2013. Threatened, silenced. Salgado's political connections bought time. Years of time. Time to move assets offshore. Time to hide evidence. Time to sell more bonds to unsuspecting retirees. Not unique to Portugal. China. Or wrong. Lai Xiaomen's party connections delayed investigation 3 years. Bernie Madoff. SEC investigated 3 times, found nothing. Madoff had connections. 1MDB, Malaysia. Prime Minister Najib protected by office for years. Pattern. The more politically connected, the longer fraud continues, the bigger the damage. Tragedy. By the time action happens, too late. Billions gone. Lives destroyed. Savings wiped. Auditor who warned 2011? Right. Analyst who warned 2013? Right. Central bank investigators 2012? Right. All ignored. All proven correct. 3 years too late. This pattern isn't finished. Right now, 2026. Italian Monte dei Paschi, world's oldest bank, struggling with $20+ billion in bad loans. Complex corporate structure similar to BES. Political connections delaying full restructuring. Multiple government bailouts since 2013. Stage 3 warning signs. Delayed financial reports. Check. Rising bond yields. Check. Analyst warnings ignored. Check. Government hoping problem resolves itself. Check if pattern holds. And it always does. We'll see another European banking crisis by 2027, 2028. Watch for it. 1. Major Italian or Spanish bank delaying annual report by 3+ months. 2. Bond yields jumping 200+ basis points in single month. Sudden CEO removals at family-controlled European banks. Warong. Warnings 2016. Collapse 2018. Gap 2 years. Evergrande. Warnings 2019. Default 2021. Gap 2 years. BES. Warnings 2012. Collapse 2014. Gap 2 years. Pattern says it will happen again. I'm watching Monte dei Paschi bond spreads. You should too. Because the incentives that created these scandals, political influence over banking, family control without oversight, regulators afraid to act, those incentives still exist. August 3rd, 2014, 10:15 p.m. Ricardo Salgado sat in police custody. Outside his apartment window, Lisbon continued. Tourists in cafes, couples walking, life moving forward. Inside, silence. His father told him once, "The name Espírito Santo means Holy Spirit. It's sacred, protected always." Salgado built empire, rose from family business to control 80 billion 7 generations of history behind him. Political connections. Respect, power. But forgot one thing. Sacred names mean nothing if sacred trust is broken. Destroyed in 14 days, not by market forces, not by bad luck, by choices, by greed masked as ambition, by complexity designed to hide, by connections used to delay. His family lost a fortune, but families like Maria Rodriguez, the retired teacher who died in poverty, they lost everything. Their crime? Trusting a name that had meant safety for 145 years. 145 years. Here's the uncomfortable truth. System that created BES hasn't fundamentally changed. Family-controlled banks still operate across Europe. Complex holding structures still legal. Political connections still buy time. Regulators still afraid to act until too late. Different name, different country, same incentives. Pattern says this will happen again. I'll be watching Monte dei Paschi bond spreads, delayed financial reports from major European banks, sudden leadership changes without explanation. If Italian government injects more capital into Monte dei Paschi, third bailout in 10 years, that confirms stage 4. History says European banking crisis repeats every 6 to 8 years. Last major, BES 2014. Before that, multiple Spanish banks 2012. Before that, Irish banks 2009. Been 12 years since last, we're overdue. The Espírito Santo name is gone. Removed from every building, every document, every business. 145 years erased. But the lesson remains. Legacy without accountability is just a countdown timer. Salgado sits in house arrest. Trial ongoing. Alzheimer's diagnosis convenient. The $7.8 billion Portuguese taxpayers paid? Never recovered. Maria Rodriguez's $50,000 gone forever. 20,000 families like hers still waiting for justice. Because in the end, the pattern never changes. Those who cause crises escape. Those who trust pay. And the system that enabled it all, still running. Same machine, different name. Next target. The only question is, will anyone see it coming next time?